Hey, Kieran Sutherland, Financial Planner here. A common question we get when we're going through the different types of insurance available is, if I have trauma and income or mortgage protection, can they both pay out at the same time? The short answer is yes, they can. I'm going to take you through some of the key differences between the two covers and how you might like to think about how to use each one. First up, the differences. Trauma, or as I call it, major illness cover, pays out on diagnosis of specific major health events, with the big three being cancer, stroke, and heart attack. Income or mortgage protection pays out due to being unable to work due to illness, and redundancy cover can be added, but often isn't good value for money. Trauma pays out a lump sum, whereas income or mortgage cover is an ongoing monthly payment for a set time period. This might be 2 years, 5 years, or right through to age 65 or 70, depending on the options you choose. So which is better? Like most things, it depends. So in the event of one of the specific illnesses on a trauma policy, take cancer for example, you may be better off with that sort of policy, as you'll get an agreed lump sum paid out that you can use for whatever you want, and potentially you won't be off work for that long. The issue is that it is just a one-off lump sum, so if you end up being unable to work for a longer period, you may run out of money fairly quickly. Income or mortgage protection is much better for something that stops you working for the medium or long term, as you can continue to get paid for a long period of time. For example, $5,000 a month for 10 years is about $600,000. Most people wouldn't have this much trauma cover simply due to cost. So what do? We tend to think of the two covers separately for different purposes and complementing each other. Trauma is to provide immediate options to people, whether to work or not. Maybe a partner is off work, and so being able to take them to and from treatment. And the biggest one, having flexible treatment options. For example, paying for drugs that aren't available in New Zealand. And then we use income and mortgage protection to account for lost income, making sure that if you can't work, you have a good chunk of your income coming in to keep life going. So there you have it. Both can pay at the same time, but also there are key differences between the two and why you might consider having both. If you want to have a chat about anything I've talked about, jump onto our website and book some time to have a chat. Cheers.